Welcome, we're Econospire. Today we're presenting our Econ 3024 research project. We're going to focus on how is depreciation affecting Turkey's high inflation rates. After introducing the recent depreciation situation, we're going to talk about our thesis statement. Then we'll include the causes of depreciation, effects of depreciation, current inflation situation, findings that actually support our thesis, as well as the regression analysis. Finally, we'll reach a final verdict. To begin with, a bit of the background information. For decades, high and persistent inflation has been a major characteristic of the Turkish economy. To alleviate the situation, the Turkish government has tried to implement several disinflation programs in 1980, 1994, 1999, and 2001, yet to no avail. The implementation of the policies were temporal and unstable. The disappointing result was mainly caused by political instabilities. As shown in the figure, there are two major economic downturns, one in the 1980s and the other in the year 2000. The former one is resulting from inadequate macroeconomic policies and weak institutional and regulatory environment, while the latter one is caused by the volatile growth pattern. Now let me talk about the depreciation of Lira. Ever since 1992, the Turkish lira has always been depreciating. In the second week of November 2021, the Turkish lira depreciated 9.9 past the US dollar, which is a record low. The causes of the sudden depreciation is believed to be inflationary pressure and monetary policy credibility. What's more, according to Trading Economics, the annual inflation rate in Turkey edged up to 19.89% in October 2021. Not only is this figure above central bank's policy rate, it is also at its highest level in more than 2 years. This indicates that the inflation trend is getting more stringent. However, an even more shocking data we found came from an independent inflation research group known as ANAG Group, which was stated to be 79.87 as of October 2021. The discrepancies of the data sets raise concerns on the credibility of the data sources. Our hypothesis is that depreciation is one of the main drivers of the high inflation rates in Turkish economy. And today, our focus will be the effects of depreciation on inflation through monetary policy, trade, tourism, dollarization, and external debt. In Turkey, it's commonly argued that the consistency of the high and persistent interest rates since the 1970s has been caused by high public sector budget deficits, monetization of public sector budget deficits, massive infrastructure investments of various governments, high military expenditures associated with geopolitical reasons, political instabilities which result in inflationary pressure due to populist policies that have ensued prior to general election, persistent inflationary expectations of economic agents, inflationary effects of changes in the exchange rates, higher increases in prices of imported inputs, occasional increases in world prices of major important inputs, increases in regulated prices of public sector products, which are mainly used as inputs by the domestic private sector, and rising interest rates resulting from the crowding out effect of public sector borrowing in a shallow domestic capital market. In today's research, we'll put the focus on the macroeconomic side, specifically the effects of depreciation on inflation through economic factors, including monetary policies, trade, tourism, dollarization, and external debt will be investigated and discussed. Now let's move on to the causes of depreciation. The first one will be monetary policy. The Turkish central bank has weak monetary policies and its approach is often different from other central banks around the world. The president of Turkey, Recep Tayyip Erdogan, Believes that high interest rates are nothing but a negative variable in the economic performance, which will slow down the path of economic growth. This is known as the unorthodox monetary policy. Despite the theories being historically proven incorrect, his believers as well as the stakeholders with interests aligned suggest and raise monetary policies with this basis. Which is why the Turkish central bank seldom increases its interest rates. 2017, the central bank has raised interest rates 6 times, but has reduced it for 10 times. In March this year, the Central Bank of Turkey has promised to hold the policy rate below 19%. However, in August, the expected annual inflation rate rose to 19.25%. And given the situation, the CBRT still cuts its policy rates 100 basis points to 18% in September. Instead of implementing tighter policies, just like most central banks in other countries, it adopted an alternate approach in leading in it. Not only has this move further increased the inflation rate, but also shocked both the general public as well as foreign investors. The value of Lira has dropped to a new all-time low. The central bank has lost its credibility with its unconventional monetary policies, and this is further proven by credit rating agency Moody's research that the Turkish monetary policy is ineffective in facing persistent inflationary pressure.
We believe one of the biggest reasons behind Turkey's depreciation is its sustained trade deficit. Turkey's trade balance has been in deficit since 2016. In 2017, the trade gap widened 36.8% from previous year to US dollar 76.7 billion. As imports jumped 17.7%, the sharpest increase since 2011, and exports rose at a slower 10.2%. The main drivers of the increase in imports seem to have been the increased energy import bill, as well as higher net gold imports. Turkey's energy import bill increased by 104% to 4.36 billion in August this year compared to the same month last year due to an increase in the country's industrial production. The data shows that Turkey's overall import bill, including energy and other items, totaled 23.17 billion in August, with energy accounting for 18.8% of the overall import figures. The country's crude oil imports showed a 52% increase compared to August 2020. With increasing oil prices, this increased production costs and domestic prices. In terms of Turkey's food imports, there is also a general increasing trend in Turkey's food imports between 2014 and 2019. This is in line with Turkey's decrease in agricultural production. The number of farmers in Turkey declined significantly, from 1.1 million in 2010 to 568,000 in 2020, while the country's agricultural land decreased by more than 18% between 2002 and 2020. This has led Turkey to become increasingly dependent on agricultural imports. Recently, however, the deficit has narrowed in 2021 September since the same period last year, likely due to the global demand recovery and falling lira.
When it comes to the decline in tourism in Turkey, Turkey was struck by the pandemic. Turkey's tourism income has narrowed significantly this year as the COVID-19 pandemic led to worldwide travel restrictions, border shutdowns, and an overall drop in consumer demand. In 2019, the total tourism income was 34.52 billion US dollars. However, in 2020, the total tourism income was plummeted to only 12.6 billion US dollars. This reflected a 65.1% percentage decrease, showing that the sector was heavily devastated by COVID-19. This caused less demand for Turkish lira and further supported the depreciation indirectly.
Dollarization, in which people swap liras for dollars, has also caused Lira to lose its value. As mentioned before, monetary policy proposed by the Turkish Central Bank has been surprising to financial markets by cutting rates while facing shocking inflation, leading to Lira losing 20% of its value during this year only. When Turkish people realized the cash they are holding is losing its value, they started to exchange their liras for dollars, which is deemed to be a more stable currency in order to prevent the depreciation of lira to erode their savings. As of last month, Turkish citizens have bought a net 1.7 billion US dollars of foreign currency, while dollar deposits constitute 60% of overall bank deposits. As a result, it restricts the effectiveness of economic intervention as fewer people are holding lira, and also led to worsened depreciation of lira due to increase in supply of local currency in the Turkish market. External debt is another factor that has led to depreciation of lira. As of the second quarter of 2021, Turkey has accumulated 446 billion US dollars of external debt, in which 164 billion of it contributes to short-term debt, expiring in 12 months. On the other hand, the Turkish Central Bank has a low forex reserve. Its net international reserves is only 10.68 billion US dollars, with lack of foreign currencies to repay their foreign lenders. Central banks need to cash out the lira for foreign currencies. This leads to an increase in supply of lira in the market, and when money supply increases, lira depreciates as a result.
Now let's talk about the effects of depreciation and inflation. Turkish lira continues to depreciate as it hit its record low in November 2021, being at an exchange rate of 1 USD to 9.97 Turkish liras. This trend has created tremendous effects in many aspects, the most severe being inflation. The devaluation of Turkish lira indicates that local products are cheaper to foreign countries, increasing the quantity of exports at the same time signifying more expensive imports, decreasing quantity of imports. This is supposed to create a trade surplus. However, the actual case in Turkey is entirely the opposite. According to Reuters, Turkish trade deficit widened 51% year-on-year in July 2021 to an astounding 4.2 billion US dollars. This is due to the large proportion of investments in capital goods, intermediate goods, and raw materials due to the lack of domestic substitutions, while only a small amount on consumer goods. The more expensive foreign products directly increase the price of consumer goods, while the higher cost of production of manufacturer indirectly induce extra costs to consumers, inflating the whole economy. The rise in prices has made it difficult for low-income households to pay for even basic necessities. Conversely, high inflation rates provoke the devaluation movement. As stated by the global economic dynamics, when Turkish companies have rising production costs, they cannot sell products overseas, lessening the demand for Turkish products, hence Turkish lira loses its values, bringing higher prices in Turkey, causing high inflation. This enters an unhealthy, vicious cycle of inflation and currency devaluation. The empirical results also underscore the importance of dollarization in the dynamics of inflation in Turkey. The findings are consistent with the view that shocks to dollarization lead to an increase in the monetary base to produce the required inflation tax for a given budget deficit. Moreover, the results imply that the decline in inflation tax, which occurs as the public switches from domestic to foreign money holdings, is in part compensated by increases in administrated prices. In line with the results of the previous studies, the findings also highlight that the exchange rate responds positively to dollarization shocks owing to the high elasticity of substitution. The fact that an increase in dollarization affects the evolution of inflation adversely suggests that the decline in dollarization would have a favorable impact on the dynamics of inflation. When it comes to the monetary policies, in the worst case scenario, the Central Bank of the Republic of Turkey will continue the rate cut policy by ignoring Turkish lira depreciation, and this will eventually lead to a balance of payments crisis. This less likely scenario would entail an inability to redeem external debts and pay for imports, which will further worsen the inflation rates. Price increases, particularly in tourism areas, due to decreasing tourism income trends, have also caused inflation to rise, with the knock-on effect of causing the purchasing power of local residents to fall. Producers have had no choice but to raise their prices due to the fact that the national currency lost value against foreign currency, and the purchasing power of foreigners or citizens living abroad has increased along with the desire to buy high-priced products. However, not many foreigners visited the country, resulting in higher price levels but low demand. Lastly, structural external debt causes an increase in money supply in the Turkish economy, reducing people's purchasing power, and this also drives up inflation rates. According to our findings, these are the effects of depreciation and its causes on inflation. Now let's talk about the quantitative analysis on the inflationary effects of depreciation. Our first model is based on import prices, where PM is the import price where we use the annual. When it comes to our quantitative analysis, we're going to be using OLS regression model. The effect of depreciation on consumer prices comes from its effects on import prices. Therefore, we will analyze two different regression models to investigate the effects of depreciation. In our first model, we will analyze the effect of depreciation on import prices, and in our second model, we will analyze the effects of import prices and interest rate on consumer prices. Our first model is based on import prices, where PM is the import price where we use the annual price level of USA output side GDP in 2017 of Turkish imports at the time T, and ET is the average annual real exchange rate of the Turkish lira at the time. You will see the model summary on the screen. And the findings from the regression analysis show us that the regression has an adjusted R-square of 0.3754, showing that the depreciation can explain 37.54% of the variance of price of imports. The T statistics of ET is given, which is significant at the 99.9 level, showing that the two variables are highly correlated. There is a low residual standard error, suggesting that the model fits the data well. While the depreciation had a clear effect on import prices, there might have been other variables that also played a significant role on the import price, such as a change in the composition of imports or an increase in foreign export prices due to a possible lowering of tariffs. When it comes to our second model that is based on domestic prices, as discussed earlier, the low interest rates have seemed to have played a significant role in Turkey's inflation. Since it is an important variable that's hard to ignore, we will be considering both interest rates and import price. We will also be comparing them to see if one may be more or less dominant than the other in terms of effects on domestic prices. You'll be seeing the empirical results on the screen. And the findings from the regression analysis shows us that the regression has an adjusted R-square of 0.718, showing that the variables can explain 71.8% of the variance of CPI. Import price is not significant at the 99.9%, 99%, 95%, or 90% significant level. Meaning, according to the data, we have to accept the null hypothesis that import price has no significant effect on CPI. The T statistics of IRT is 0.00222, showing that it's significant at the 99% level. Hence, there is a high correlation between interest rates and CPI. Data regarding residuals suggest that there is a lot of variation in the observed CPI, and the high residual error suggests that the model does not accurately fit the data. From this regression analysis, it seems that the interest rates were far more influential in the rising inflation compared to import prices, which did not seem significant. We believe the reason to be the lack of data. We could only include 10 data points due to the limited data available for interest rates, where we could only access data starting from 2010. Another possible explanation for the low significance of import price could be due to the effects of political instability that might have had a much larger effect relatively. Let's conclude and evaluate our paper. The initial answer to our thesis statement would have been that depreciation is one of the main drivers of the high inflation rates in the Turkish economy. It seems that depreciation does play a significant role in the high inflation rates, since Turkey's trade deficit leads to the vicious cycle of inflation and currency depreciation. While the empirical data, to some extent, supports our reasoning that the depreciation leads to the rising import prices, the findings of the effects of depreciation and inflation seems inconclusive, possibly due to shortcomings in our data analysis, as explained before. Using our findings alone, it could be reasoned that while depreciation may not be as significant as we initially thought, the monetary policy played a much more significant role in Turkey's inflation, especially given its counterintuitive nature, leading to unpredictability and hence further discouraging foreign investment. It could also be argued that the ongoing import dependency of Turkey, with trade deficit and structural external debt, might have played a major role in Lira's weakening value and inflation. Lastly, dollarization seems to have fueled Turkey's inflation, as it is affected heavily by speculation, leading to another vicious cycle of falling confidence and depreciation of Lira.